I'm endlessly fascinated and curious about the world around us, about business, about politics, about the arts, about culture, developments, social issues, and the people. Most importantly, about the people that are shaping our future. Every night, I get the opportunity to have conversations, to dive into conversations with thought leaders, with change makers, entrepreneurs, politicians, and everyday heroes who unpack the ideas and stories that I think matter to all of us. What's the future of our economy? What's the future of our country? How do we build stronger communities? What can we learn from music, theater, sports, politics, the arts? How does policy shape our real lives? What does leadership look like, real leadership in today's environment? If it's interesting and relevant and topical and we're talking about it, you'll hear about it here at 6 o'clock on the Brian Crombie Radio Hour. I want to have real conversations, in-depth conversations. These are ideas we're sharing. This is the Brian Crombie Radio Hour. Thanks for joining me. Good evening, everyone, and welcome to the Brian Crombie Radio Hour. We're going to talk a little bit about investment management tonight, because I think that, number one, all of us have got retirement funds and a little bit of money that we want to invest in. So understanding what's happening with the markets, where to invest, how to invest, is one of those critical things that we do and probably don't spend enough time thinking about. And so it's worthwhile talking to an expert and understanding a little bit more about it. And then also, I've met Alex Letko, our guest, previously, and his company has got a really interesting story. And so I think that that's worth a conversation. Our guest, Alex Letko, is the regional manager for Central Canada for Letko Brossard, a Canadian independent investment manager. They got $19 billion of assets under management, and he leads their Toronto office. We're going to chat a little bit with him about his background, about how he got into this business, about Letko Brossard, and about the markets. Alex, welcome to the show.
Thanks for having me, Brian.
My pleasure. So tell me, first off the top, how your company, how your firm is different than the typical investment management company.
That's a great question, Brian. Well, first of all, we label ourselves a little bit of a boutique or independent investment management firm. And so what that means to us is independent of thought and independence in terms of how we allocate our clients' capital. And so what we do is we put in a great deal of diligence and research into the companies and the fixed income products that we invest in. And so we're not a firm that's trying to make a quick buck by trading around the quarter. We're very long-term oriented. We do a great deal of research and in-depth work to understand the companies. We consider ourselves as partners with the companies longer term. And so I think that that's one of the hallmarks of our investment process, is really the in-depth diligence that we carry out.
So most people these days are just, buying the index. Why is your process better and different?
Yeah. So, so the index investing, passive investing has really, it's taken the investment management industry by storm. It really has. It was about 25% of total assets under management about 10 years or so ago, and today it's about 50%. And just a year or two ago in the United States, index investing or passive investing surpassed active management for the first time. It's now about $15 trillion of assets under management. And so this is really this has brought about questions as to whether or not active management is dead. Why on earth someone would need to even hire an active manager? And so I think that there's great value in having somebody make investment decisions from being curious about the world, trying to understand things, trying to understand the companies that are being invested in, and to make allocation of capital on behalf of clients according to that. And so I'll give you an example. So in 1987, our firm was founded, and had you invested in a global balanced benchmark of securities through passive ETFs in 1987, that would have mirrored global equities and fixed income. You would have made, had you invested $1 million in that cocktail, you would have made about $15 million on that investment. That's a compound annual growth rate of about 7.8%. Had you invested with Letko Brossard's global balance mandate, you would have made about $45 million. So that's about triple the amount. And this is what it comes down to in the investment management industry, is that we work on behalf of people that have financial objectives. And so whether or not that's purchasing a new car or affording a down payment on a new home or leaving a certain amount of money for your kids or funding a charitable organization. People have investment objectives, and adding a few basis points or a few percentage points to return over a long period of time goes a tremendous way in helping people achieve those objectives. So there's tremendous value in active management.
What are ETFs? You said ETFs. What are ETFs? Can you explain that to everybody, please?
So ETFs are exchange traded funds. And so what they are is, let's say you wanted to own a portfolio of securities. Let's say you wanted to mirror the benchmark, say the S&P 500. It used to be you would have to buy each one of those 500 stocks. But an ETF is a product where you buy the stock, you buy the ETF, and it gives you a little slice of the index. And so what that's done is it's allowed people to diversify their holdings a lot more easily than it has before.
So, I went to business school and they talked about rational markets and that there was no opportunity for anyone to beat the market. If there's no opportunity for anyone to beat the market, if all the information that is out there is already reflected in market pricing, how can you actually beat the market? How can you do better via active management? Why don't I just buy the index?
Well, if that were true, Brian, if all information was properly reflected in the market, then it wouldn't be possible for active managers like ourselves to consistently beat the market over time. And so I mentioned our global balanced fund, but you can look at all the investments we've made in Canadian public equities since 1987, and they've returned compound annually about 14.5%. And the benchmark returned about 9%. And so we've consistently, and other active managers have done this as well, consistently beaten the market. And so what that necessarily implies is that not all information is reflected. And so again, there's a tremendous amount of value that can be said for actually doing the work. Not just simply, sitting back and pushing a button and owning the index, but actually doing the diligence and the work required to understand the world, understand the companies that you're investing in.
Well, the retort that I've always heard is that, an economist that believes in rational markets and efficient markets would tell you if you saw $10 on the sidewalk, don't bother picking it up because it's already been picked up by somebody else. And it doesn't, that $10 sitting on the sidewalk doesn't exist in reality. But clearly it does. And by picking it up, you're actually making the market efficient. And so I think what you're doing in your active management is making the market efficient. And other active managers are doing the same thing. So if you didn't have a whole bunch of active managers, the market wouldn't become efficient. It's your role in exploiting the inefficiencies that make it effectively efficient after time. I won't make you respond to that unless you want to.
No, that's a great perspective, Brian, and of course I agree with a large part of what you're saying there.
So, there's different strategies that people have talked about. I wonder if you can explain how they're different and if you follow one. There's this sort of value investing strategy where people follow low price earnings ratio stocks. There's a growth strategy and there's an index strategy, and maybe you've got some others, but can you describe sort of different strategies and what they are?
Sure. The index strategy, I think I already probably hit on it, which is just sort of owning the index, owning the broader market. And your hands are completely in the wisdom of the crowd. If the market goes up, then you go up. If the market goes down, then you go up. Growth investing would be in owning typically more expensive stocks that are pricing in higher rates of growth over time. And so the idea would be that they'd be able to compound their earnings over time. And value investing would be trying to own stocks that are not quite pricing in all the upside just yet. And so we consider ourselves more in the value camp. We don't like to bucket ourselves. But when clients come and look at us and compare to others, they see a little bit more value. And what we mean by value investing, it's the same thing if you were buying, a car or something. You would want to make sure that it's well made, that it's good quality, and that you're not overpaying for it. And so it's the same thing in investing in the stock market. You want to make sure that what you're buying is a solid, high quality company, that the management team knows what they're doing, and that you're not overpaying for it. the more that you overpay for a security, the more you overpay for anything, the more risk that you're putting on the table. And so when we as value managers think about investing, first and foremost, top of mind is preservation of our clients' capital. We don't want to overly risk our clients' capital. If you pay up for something like a growth stock that is already pricing in a lot of the upside, well, if it goes great, then fine, you'll make money. But if it doesn't go well, there's a lot more downside. But if you invest by protecting the downside through being very attentive to the valuation and the price that you're paying, then there's simply less downside in case something bad happens, and you retain a lot of upside as well. So that's how we think about value investing.
There was a famous book by Ben somebody rather about value investing. Do you follow that book? What do you know who I'm talking about?
Well, there's a lot of books on value investing, to be honest. But what is it about that book that you'd like to bring
I
up?
think it's Ben Templeton or something like that. It's the book that everyone talks about as being the Bible of value investing. Anyway, I was getting, that book talked about where the book value of the asset was greater than the stock price, and the price earnings ratio was low. So you wanted to find stocks where they were asset rich but weren't earning a lot of money. Is that something you look at?
Yeah, and I think the Ben you're talking about might be Benjamin Graham. I'm not
Sorry, that's it.
100% sure. Yeah, but that's one way of looking at it, absolutely. And so you want to invest in companies where they have assets or potential that is not recognized by the market, where the price is not reflective of that potential. And so we find that over time, and that's been an investment philosophy of ours that really hasn't changed since 1987. We find over time that that's reaped, tremendous rewards for our clients. We've been able to protect the downside while ensuring, a very good upside as well.
Warren Buffett, I think, often said that he'd rather invest in a company that had great management, even if the company wasn't great, rather than a company that was great with bad management. What do you think about that?
It's an interesting perspective, and I don't entirely disagree with it. I think there's a lot of different ways to make money, and so I wouldn't want to paint everything with the same broad brushstroke. Certainly, when we go about our diligence process, and I talked about a little bit about the fundamental diligence process that we undertake. One of the very most important things that we do is we want to interview the management team. We want to talk to the CEO or the CFO, and we want to understand how they think about the business. And so for us to be able to assess management's competency and also their long-term alignment with shareholders is tremendously important. So I think Mr. Buffett was onto something.
I used to work for Jim Pattison, who you may know from reputation. He's a reasonably successful billionaire on the west coast of Canada. And he would always say, Brian, you're investing in people, and you got to get to know these people really well. Do you agree?
Absolutely. I think it goes exactly with what I was just saying, that the management teams of these companies go a long way to ensuring that they're successful, or vice versa. And so we are investing in people, absolutely.
So, Buffett's comment about he'd rather invest in a B company with an A management team than an A company with a B or C management team, you would agree with?
Yes, as you pointed out before.
How do you do that? You interview people, you say. Buffett interviewed people, Jimmy Pattison interviewed people, but how do you actually do that? How do you assess a management team?
That's a great question. And first of all, it comes with experience. I mean, I don't know how many interviews you've done by now, Brian, but you can probably assess your interviewee a little bit better than you could right at first. And so there's a certain amount of experience. But you want to make sure to ask, for instance, open-ended questions and to let the management team tell you sort of what is top of mind and kind of see what it is that bubbles to the surface in their thought process. And so I think that if you do that enough times, it becomes a little bit more clear over time, sort of which management teams have the chops and which might not. It is very important, I think, to not just speak with the management team once. We like to get to know the companies for a certain period of time before we invest, typically. And so oftentimes we'll speak with one or two or three members of the management team over a long period of time. And so that allows us to get to know them a little bit. And so it's a process, Brian. It's just a process.
Jimmy Pattison had an interesting strategy that I'll volunteer up for you and for the listeners because it was interesting. He always wanted to go to their side of business rather than having them come to him. He says, efficiency, maybe it's better if they come to see you, but I want to get to see them in their own place of business. I want to tour their factory or tour their store, or tour their real estate development or tour, their laboratories or something like that. He says, I want to see how they interact with their employees. I want to see how they can describe their plant or describe their laboratory to see if they actually know what the blank they're talking about. And you can tell that far better when they're actually doing a tour and walking you around than you can if they got a PowerPoint presentation that they're flipping through in your office. And he said that that will always give you a chance for a lunch or a breakfast or a dinner. And he says you'll learn more about the ability for them to be good managers over that social interaction than you will in the hour that you spend flipping through a flip book in the boardroom table. What do you think of that?
I absolutely agree. And so it's interesting that, it's kind of exciting if you're a junior analyst and you join our team. We have about 20 portfolio managers and analysts on our investment team. If you're a junior analyst, you join Letko. So one of the first things you'll notice is there's no cap on the travel budget. So you're encouraged by the top layers of our management to get out there and sort of, we call it tasting the ice cream. Get out there, do as many site visits, factory tours, go to conferences as you need. Pardon me, I'm just gonna. And so that gives us a real sense of sort of what's going on in the field. And the more times you do that, the more you understand about the business. And so that's a really, really important part of our diligence.
Markets are incredibly volatile today. And people are thinking the market's going to go up or going to go down based on politics or what Donald Trump is doing, et cetera, et cetera. We're going to take a break for some messages. When we come back, I'm going to ask our guest, Alex Letko, a little bit about what he thinks is happening in the markets and also about AI stocks and if we're into potentially bubble territory. And he's got, I think, an interesting story about what his firm did during prior boom bust cycles. Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour. We're talking investments today, investing in the market with Alex Letko. He is the regional manager for Central Canada for Letko Brassard, a Canadian independent manager. He's got $19 billion of assets under management. This gentleman is one of these smart guys you meet in life. He leads their firm here in Toronto, but prior, he worked in the sell side research in New York City. So that'll be interesting. He was one of these guys on Wall Street. He's a graduate of Columbia University with an MBA, University College Dublin with a master's in economics, and McGill University with a bachelor's in economics. And he's also a chartered financial analyst holder. So he's a numbers guy, but he's also a business guy with two masters and a bachelor's as well. So you've got tons of letters after your name, buddy.
Yeah, maybe too many, a little bit too much time with the books, to be honest. But no, I love learning, and all of us here on the research team at Letko, so that's what we do. We're curious about the world, and we love learning about it. So
I think if you go with Alex, you probably have more letters after your name. If you went with Alexander, then you might be equal with letters in the name versus after the name. And Letko Brasseur is a pretty impressive company itself. When were you founded?
So Letko was founded in 1987 by my father, Peter Letko, and his business partner, Danielle Brosseau. It's a really interesting sort of quintessentially Canadian success story, and it starts not in Canada, but in Czechoslovakia. My father was born in Czechoslovakia at the time, Slovakia now, and he was born to his father was a business owner. His mother was one of the very first female lawyers in Slovakia and probably in that part of the world. But between World War II and the Iron Curtain coming down, they essentially lost everything. And like so many at the time, they found themselves on a boat headed for greener pastures in North America. They settled in Montreal, and to make ends meet, my grandparents sewed children's clothing in their basement. And that's what gave their son an opportunity to kind of make the most of this amazing country. And so he went to McGill, got an education, found his way into finance, ended up at the CN Pension Fund, which was the largest private pension fund in the country at the time. And that's where he met his business partner, Danielle Brosseau, and they basically worked their butts off at the CN Pension Fund and rose through the ranks. And then in 1987, finally, they tendered their resignation in September. And then 1 month later, the infamous October of 1987, they founded Letko Brosseau.
What a wonderful timing. So what happened in the fall of 1987?
Yeah, wonderful, depending on how you look at it, Brian. October 1987 is home to Black Monday, October 19th, 1987. And when you think of the great stock market crashes in history, you might think of the 1928 crash that precipitated the Great Depression, or 29. You might think of the Great Financial Crisis or the pandemic, but it's actually Black Monday, 1987. That's the worst stock market crash, single day crash in history. The Dow fell about 23% or so. And so, for most people starting a finance firm, an investment management firm at that time, that probably would have spelled disaster. But they saw things a little bit differently. They saw that the reason that the stock market crashed, and they foresaw this, is because in 1987, interest rates had practically doubled over that time. And yet the stock market continued grinding higher. And students of finance will know that usually those two things are negatively correlated. Usually, as interest rates go faster, go higher, especially so quickly, the stock market usually doesn't like that. It raises borrowing costs on everyone. Companies have less profits, and it also reduces the valuation on the companies. And so usually stocks crash when interest rates go up. But that didn't happen yet in 1987. So they foresaw this coming. And so when it did happen, they were not running for the fences like a lot of their peers. They were ready. And so they put money to work very quickly. They only had a couple of accounts as clients, their two mothers. But soon a lot of other investors followed as they gained a lot of success coming out of the crash there. And so very interesting timing, I would say, to start an investment management company.
Very interesting. I'll tell you my own personal story. I also got an MBA, and I worked on Wall Street the summer of 1987, and thought at the time that Wall Street future was in my career, and then went back to my second year of business school in the fall of 1987. And as you say, in October, obviously every class was focused on what had just happened on Wall Street, and that's when I decided to go into industry. So maybe I made the wrong mistake and should have followed your father's track and still gone into Wall Street financial sector rather than saying, I'm out of here. I don't want this. But, I had some people that I knew that someone who I knew that knew the gentleman that threw himself out of the CSFB window. So I didn't know him personally, but knew someone who knew him, and then knew lots of other people that really came to huge collapses of their monetary wealth, and firms that went under after 1987. It was really quite a catastrophic crash. We've got volatility today, and I'm told, and you would know far better than I, but the stock market that people brag about, that Donald Trump brags about, is at a high in the United States. If you took out something like 5 companies, it wouldn't be. That the vast majority of the current market valuation of the Dow Jones is 5 AI-related companies. Is that true?
Yeah. So if you look at the market today, about 40% of the market cap of the S&P 500 is the top 10 companies. It's pretty much unprecedented in modern times. And if you look at the total market cap in the S&P 500, it trades very expensively. So over 70% of all the market cap in the S&P 500 trades at an earnings multiple of over 20 times. There's only been a couple times in history that's happened. One was the zero interest rate environment right at the pandemic, but that was a funny time. But before that, you have to go all the way back to the dot-com boom. So historically, in some ways, the way you cut up the market and the valuations these days, the market has never been quite as expensive as this, and so we see that, and we see a lot of cause for optimism. There are good reasons why a lot of these stocks are trading up. They're growing very rapidly, and I'm not taking anything away from the secular trend that is AI. AI is here to stay, and it's going to change our world in ways that are probably somewhat unfathomable to us today. That said, just like in the dot-com boom, when the internet ultimately changed the way that we live and work, the market got it wrong back then. The market can still get it wrong today. And so we see a little bit of a risk in the market. We see a little bit of risk in certain stocks that, as soon as they're enveloped by the aura of AI, they immediately start trading up. I'll give you an example. So Oracle is a stock that reported earnings a couple of weeks ago, and they made an announcement that their business was growing faster and they were gaining more backlog because of AI-related demand. It took just a few minutes for the stock to shoot up about 35%. And this is not a penny stock. This is already a stock that was around a $500 billion market cap. And so for $250 billion of capital to flow into any one stock in a matter of minutes or a day just goes to show how the market right now is probably in a shoot first, ask questions later sort of mode. And so when we see that, it reminds us of other times like, the dot-com boom, like I mentioned, where, investors were probably met with, or probably, exuded a little bit too much exuberance. And so when animal spirits sort of start to get going like this, we do find reason for caution. And so what we've done over the last year or so is we've raised a little bit of cash in our portfolios, and we're happy to be sitting on a bit of cash just in case we do get opportunities to redeploy some of that.
Lots of us have read that book or seen the movie about The Big Short. Would you short AI stocks today?
So we're not a long short fund, first of all. We're a long only money manager. We only take long positions. We only want to see the companies do well over time. So, but the other question is, would you invest in them? And we are invested in some stocks that are greatly benefiting AI from AI. But that said, we only want to do so in a very prudent way. And so if you look at some of the stocks, the NVIDIAs of the world, and this is not to say that those stocks are going to crash down or anything like that, but if you were to pay up for those stocks at current valuations, you would be paying a price that implies that they continue to be successful growing the business for a long period of time. And so that's fine. You'll make money if they continue to be successful. But if anything bad happens, if they're not able to meet their earnings targets, et cetera, then there's a lot of error in the valuation, a lot of opportunity to potentially lose money. And so for us, as very prudent allocators of our clients' capital, we simply don't feel comfortable in those sorts of environments putting too much money on the table in those specific stocks. And so it's nothing to take away from the AI as a secular trend. I mean, again, this is going to change the world in ways that are hard to even imagine. But the market seems to be a little bit over exuberant right now.
So the sort of the analogy that I've heard in that regard is, railways in the 1890s, 1900s changed America, changed Canada. And there was way too much investment in them, and the stocks were bid up like crazy, and a whole bunch of them went bankrupt. But that was actually great for the economy because you had a whole bunch of cheap railways available. So it didn't change the industrial economic trend, but there was too much exuberance, and you had to be very careful about who you invested in. Similarly, in the dot-com boom, there was fiber being laid all around the world, and Global Crossing and other companies, were laying like crazy and had huge, lofty valuations. Some of them went bankrupt, but that fiber was therefore available at a cheaper price. And so it was good for the economy, good for the industry, bad for a couple of stocks. Are we into a similar situation that AI is going to be great and it's going to have a profound effect, but there's some companies that are dramatically overvalued and there's going to be some bankruptcies? What do you think?
Not necessarily calling for any bankruptcies per se, Brian. I take your point, though, that a lot of the infrastructure right now is being put in place for society to benefit from AI for years to come. So you call these the hyperscalers. So the Facebooks and the Googles and the Amazons of the world right now are spending billions, collectively hundreds of billions of dollars on capital investment to purchase these AI chips and to build data centers that will house these AI capabilities for years to come. And so that is infrastructure that will be in place and that society will benefit from. But sometimes it's hard to see how these companies are really going to earn that much of a return on that capital anytime soon. And indeed, that's exactly what's going on, is that it's very difficult to see the profitability flowing through to their bottom lines currently. And that's one of the problems.
Other people have told me, don't invest in the United States right now. There's too much volatility. Canada, we're not sure about. Put your money in emerging markets. Where do you invest geographically?
So we're global investors. We invest in Canada and the US globally. We've had a lot of money since actually 1992 was our first emerging market investment. And emerging markets, by the way, for your listeners, these are places like Mexico, Brazil, India, et cetera. So non-developed economies. And so in 2011, after a number of years of success investing in emerging markets, we started our own emerging markets fund. And this has been tremendously successful because what we do is we go out there and we try to invest in the great unmet needs of these emerging market societies. So we're investing in water companies that are meeting the needs of greater access to clean water, clean drinking water, water sanitation in many of these places. We're investing in clean energy producers. We're investing in healthcare companies. As those societies, as the middle classes rise and they demand greater access to affordable healthcare, there's a world of healthcare companies out there that will cater to those needs and will see their earnings grow. And so we have a number of very interesting themes that bubble to the surface in our emerging markets portfolio. And this portfolio has done tremendously well. Since we incepted the fund in 2011, it actually ranks in the 5th percentile globally of all emerging market, all cap portfolios out there. That's according to the eVestment database, which is one of the main institutional databases used. And so it's been tremendously successful for us. But really, that's because we have this very optimistic view of that part of the world where you have basic needs in these societies that are as yet unmet. And there's a universe of companies out there that are working every day to meet those needs. And they will see their earnings grow, and they have, and they will probably continue to see that.
Tariffs are a concern to a lot of us from the United States. What do you think about investing in Canada? What do you think about the risk of tariffs? What do you think about investing in companies? And can you identify companies that are at risk of being damaged by tariffs?
Yeah, so it was one of the first things that we did as an investment management team is as the tariffs were being announced, and actually as Trump came to power last year, and we foresaw this, we looked inward at our portfolios and identified any sort of red flags or any companies that might be particularly at risk. Luckily, though, we do have a bias for investing in very, very high quality companies, and so we didn't really identify companies that needed to be trimmed from the portfolio for those reasons. That being said, it is an overhang. It's an overhang in terms of the economic impact from the tariffs, and it's an overhang in terms of the uncertainty. And so, look, we've been through these sorts of things before, Trump's first term, for instance, but we do believe that ultimately there is a community of interests where people will logically realize that if you do well, then I'll do well. And so we've had.
I hope you're right. I hope you're right.
I know, and I know a lot of people are. It's been very painful for a lot of people, and I don't mean to sugarcoat it or anything like that. But we are long-term investors, and we do believe that it is important to look around the corner. And so in Canada, the economy is getting a little bit beat up right now. So we printed a negative quarter of GDP growth last quarter. We may well print another one and be in a technical recession. But we have some firepower and some ammunition to help us get through this kind of negative period. And so namely, if you look at all the G7 countries out there, and you look at their fiscal deficits, Canada actually has just about the most favorable position, about 2% fiscal deficit as a percent of GDP. That's not very large compared to the United States, which prints a big deficit of around 7 or 8%, especially with the big, beautiful bill that's going to expand the deficit. And so actually in Canada, we do have room for the government to protect the economy a little bit here from stimulating. And the government actually has a very good balance sheet. And so it's able to do so, we believe. And so we actually foresee a situation, despite everything that's going on, where starting sometime in 2026, we actually think the Canadian economy can start growing faster than the US economy. And so we don't believe that that's widely accepted right now. And so that should benefit Canadian companies. And ultimately, by 2026, at least it seems that the United States administration is signaling that that's when, they plan on getting around to negotiating with us. And so hopefully we'll see a resolution on the trade front as well. So there are sort of, we hope, some green shoots around the corner here. And that's sort of how we see the world as it relates to tariffs.
I think you're right. And there's two sectors, maybe three, that I'd like to identify, and I'd love to hear what you think. I think that this major projects office that the government's put in place is going to accelerate some development of infrastructure and natural resources. And so if you can find the right companies that are going to be able to get faster approval and exploit that opportunity, whether it be in, pipeline construction or liquefied natural gas or critical minerals or whatever it is, I think that there's an opportunity, a great opportunity there. So that's number one. Number two, I think if we ramp up our defense spending from less than 2% to 2.5 to 3, potentially to 5 in the future, we're going to have to be spending some of that domestically, hopefully a lot of it domestically. And so therefore, defense manufacturing should be an area that should be attractive from an investment standpoint. And the third one that I'd suggest to you is pharmaceuticals, or maybe it's high tech generally, because I think that there's going to be less people going to the United States to work, given all the immigration constraints that the United States has put in place. And we're already seeing some of the brain gain that's coming to Canada from the U.S. immigration policies. And I think that's going to help some high-tech, biotech, pharmaceutical companies. What do you think about those three suggestions?
Yeah, Brian, I think where you're going with all that is that there is like a glass half full side to all of this. And hopefully the Canadian economy can structurally improve from this bit of turbulence and kind of diversify our trade partners a little bit and also change the way that we do business with each other through removing interprovincial trade barriers. And I'd like to pick up on one of the points that you made there, which is that major projects office. And I don't know if that is necessarily the right vehicle, but there is a general appreciation now, I think a little bit more than in the past, for making sure that it is easier in Canada for getting these major projects approved, specifically also in the energy space. And so, look, energy is just one of those things that Canada has a natural advantage in. We have tremendous endowment of resources in the energy sector, and it's always been a problem of getting those to market. And so if you look at the years worth of production, if you're a natural gas producer, if you're an oil producer, you have decades worth of production in Canada. In the United States, you're very short on production, relatively speaking. Same thing with most other places in the world. And so there is a competitive advantage there. And we would like to, shift to energy transition technologies and not have to rely on those parts of the economy necessarily. But the reality is that we probably will for many years to come. And so if we will, I think that Canada is better off being a net producer and supplier to the world of those sorts of resources rather than importing it from jurisdictions that might not have the same sort of regard for worker safety and environmental standards and that sort of a thing. And so if we can get some major projects in order where we can get some of those molecules to market, I think that would go a long way to helping the economy grow.
We're going to take a break for some messages and come back with some concluding comments from our guest in just 2 minutes. Stay with us, everybody. We're talking about the economy and where it's going. Stay with us. Back in 2. Welcome back, everyone, to the Brian Crombie Radio Hour. I've got Alex Letko of Letko Brassar with us tonight. We've had a really interesting conversation about his firm, his background, where they're sort of value investors and they're active investors. He's a little bit concerned about the overconcentration of the market right now in AI, and I think I'd like to read into what you said, that you're a little bit concerned with lofty valuations in AI. That said, you're convinced that there's some opportunities in the marketplace today. You like the emerging markets, and you like some sectors of Canada. You're worried that we're in a recession, that we may have a technical recession. So let me ask you, Alex, are you optimistic or pessimistic about Canada, about investing today?
Well, we're absolutely optimists, Brian. We're big believers, first of all, in Canada. I mentioned the story of the firm and how what I think is a very very nice Canadian success story, and I think it's nice to share these success stories with fellow Canadians, make them aware. Because with everything going on in the world with our neighbors to the south, it's nice to draw inspiration from one another. And so we're really optimistic in the opportunity that we have here in Canada to invest. We do think that investors should be investing more in Canada and helping bring projects to fruition, bring capital to places that it needs in order for the economy to thrive. But we're also global investors. And so, look, we've been through a lot the last decades. Every decade there's a reason to sell. If you look at the decade after the great financial crisis, so you had things like the Greek financial crisis, and there was all sorts of European sort of debt issues, all sorts of reasons for the market to sell off. But if you zoom out, the stock market kind of just had a straight left to right up. And so we can get in the thick of these sort of troughs in the market and really get down on ourselves. But I think that our firm and many investors in general have given great value to their clients from making sure that we keep our heads above the water, that we stay level-headed, and that we continue to read the tea leaves properly, and that we continue to do the work. And so whether it's through the crash of 1987 or the dot-com boom, where the phone was ringing off the hook at Letko with clients and other industry observers asking why the heck we didn't own a company called Nortel Networks. And so it's really easy in these moments of either exuberance or pessimism to kind of lose sight of the fundamentals. And so you have to just kind of stick with your thesis, stick with the research, stick with the in-depth diligence that you can do on the market and on the companies that you invest in, and think long-term. And so that's all that we're trying to do. And we're trying to do that with, as your question implies, a very optimistic lens.
If you sat down with the head of CPP or the Caisse de dépôt, what would you tell them?
I'd say that Canadians have a lot to be proud of in terms of, these are some of the great financial institutions of the world. These are global investors that put Canada on the map financially. I would also say that there's tons of opportunity to invest, not just internationally as they've done very successfully, but also in Canada as they've done very successfully. And the Caisse is one of the only ones, I believe, with a dual mandate, where their mandate is to grow the capital of their constituents, but also to invest within Quebec. And so I think it's nice that these large pool of capitals also recognize that there is opportunity domestically to invest and to help grow the economy. That's I think we're very lucky in Canada to have such a well-developed financial sector.
You're obviously very smart, and your firm's been very successful. If people want to read some of your research or potentially invest in some of your funds, how do they best do that? Is there a website they should go to?
Yeah, so our website is www.lba.ca, letkobrossoandassociates.ca, and they can reach out to us. There's a contact us link. And so feel free to do that. We'd be happy to talk to you.
Do you publish research on a regular basis?
Yeah, you can see in our perspectives on our website. We publish our quarterly economic updates, our portfolio updates. You can always go on our website and check out how we're thinking about the market these days.
So if there's a crash, I got to call you and ask what's going on.
Anytime, Brian.
This has been a fascinating conversation. I really have enjoyed it. Thanks so much. I think that a lot of us, put our money into a GIC or put it into a fund, and they don't watch what's going on either at all or enough. And I think you're right that a little bit of active investment, if not a lot of active investment, or finding someone like you that can invest for us makes a ton of sense. And we read the popular press probably about what's going on, but getting some specific opinionated research from a firm like yours is extremely helpful. I found it invaluable in my experience. And so, Alex obviously is a very smart guy. He's got the right education. He's joined an interesting firm. He's launching their Ontario office and really trying to invest and grow here. So really appreciate it, Alex. That's been a fascinating conversation, and I think I'm going to think about my portfolio a little bit more tonight when I look at my online database more than I may have done before. Maybe mostly because of you. So thanks so much.
Thank you for having me, Brian. Really appreciate it.
That's our show for tonight, everybody. Thank you for joining. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at www.saga960am.ca. All my podcasts and videos go up on my website, briancrombie.com. As soon as the radio show goes to air on my YouTube video channel, on podcast servers, my gosh, I'm everywhere. So you can grab my content. Thanks. Good night, everybody. Thanks, Alex. Really appreciate it.